Great. Thanks, Jim. We'll go ahead and get started. Thank you everyone for attending today. My name is Nathan Davis, and I'm a partner here at Aspen Wealth Management, as well as our Chief Investment Officer that's responsible for our quarterly market updates. We don't spend a lot of time, particularly in client meetings, getting too into the nitty-gritty details as it pertains to markets and economics. And so we always kind of joke that this is our once a quarter time where we can kind of silo all of that information that's out there into one presentation for anyone who's interested. Usually we try and keep it pretty relevant, pretty high level when we're meeting with clients. So I do always like this chance to kind of get into some of the things that we're reviewing on a regular basis and considerations that go into our investment philosophy and our portfolio construction. Just to say, hey, what's going on in markets? What has happened year to date so far in the quarter? What are some expectations for what we have ahead? And how does all of that translate back to our actual portfolios? What we're going to make sure we discuss today, in addition to that, we are going to, for the first time, we're going to tie a lot of these discussion points back to common client questions, just in an effort to try and take some of this really detailed information and actually apply it to questions that we receive from clients. A lot of times that's keeping an eye on the news as it occurs, watching market volatility, waiting for the next Fed announcement or GDP print or tariff discussion. And then it's pretty easy to log into Schwab and see what kind of impact it's having on your portfolio. And so it creates a lot of really great questions that we get from clients. We're going to tie these topics back to a few of those questions. And then lastly, we will wrap up with implications for investors. So what does all of this information mean? How could it possibly impact your asset allocation? How could it possibly impact your portfolio management considerations? What do we actually do with all of this information? We'll tie it back to you as investors and what sort of implications we can expect from all of this data. So just with a quick snapshot of the short-term market summary. So this is the second quarter of 2025. What happened last quarter? We had a really good quarter. It was above average returns across all asset classes. International developed stocks continued to outperform a little bit, which has now been, almost 7 months, which is pretty rare in the last 10 years. But international developed stocks in particular are kind of having their moment. Emerging market stocks didn't perform as well in the first quarter, but in the second quarter really started playing catch up and actually exceeded the performance of the US stock market as well. But all of our major asset classes were green across the board, including global real estate, the US bond market, and then the global bond market ex-US. And as you'll notice, all of the major asset classes have also outperformed their average quarterly return when we're looking back 25 years. So across the board, it was a pretty good quarter for all of the major asset classes that we care about. Taking that lens a little further out and looking at our long-term market summary, the last year, as in the last rolling 12 months, have also been very strong for markets in general. 15% returns for the US stock market, almost 19% returns for international developed. Emerging market stocks, almost exactly where the US stock market is by 1 basis point off in the last year. Green across the board. What we really have here is kind of one outlier of not providing us positive returns, and it is very close to getting to the catch-up point. When we look at the US bond market, the impact of rising rates in 2022 and into 2023 still has the 5-year average return for bonds in the negative. But as you can see, with just over 6% returns in the last year for US bonds, those now higher rates are really starting to work themselves through the market. It's just going to take time to get past the interest rate rising regime, get past some of those price depreciation, some of those price losses that we saw, and allow that higher income to actually take effect and positively impact our portfolios. But we really have seen the last 1, 5, 10, 15, 20 years have been very positive across the board for all of our major asset classes. US stocks have outperformed quite a bit the further back that we're able to go. Looking particularly in the 10 years, the 15 years, we're well above trend growth for the US. the 20-year US stock market returns of that about 10.5% is pretty close to what we would expect for the long-term average. But when you look at, 14.5% over the last 15 years, 13% for the last 10, considering some of the major developments we've had in markets in the last 10 and 15 years, we really have just seen way above average returns in the US in particular, with kind of the opposite story in internationals, whether it's developed or whether it's emerging markets, lagging their long-term averages over that same time frame. Kind of as a reminder for our world stock market performance and hey, what are the headlines that have driven market returns? And now these headlines are not offered up here to try and explain market returns. Instead, they just serve as a reminder for us as investors that we should view daily events from a long-term perspective and avoid making investment decisions based solely on the news. I mean, looking at a few of the major headlines that we have here, May 22nd, S&P 500 turns positive on the year for the first time since February. There's quite a slide there for a while. At the end of the first quarter and into the mid second quarter, May 22nd, we finally saw the S&P 500 turning positive again. We've seen a lot of positive growth in markets since then, but it's just an example of market resilience in action. Despite that earlier volatility, U.S. equities regained their footing and signaling, renewed investor confidence overall. We'll talk about investor confidence a little bit later. There's been a catalyst for a broader recovery. Oftentimes, the S&P 500 serves as almost like a bellwether for the global risk appetite. So turning positive has helped improve sentiment across all asset classes and region, not just for the United States. And then really, particularly in the U.S., we've seen underlying earnings strength. This really is an anomaly in that, hey, where are these returns coming from? Most of the volatility that we've seen has been, policy related. It's been things like tariff. It's been things like global economic events. When we try and eliminate all of that noise and just focus on the companies that we're investing in, when we invest in something like the S&P 500, the underlying earnings of those companies have been really strong. The move upwards and getting back to those new all-time highs, they really just reflect the improving earnings, some of which have been revised up after the fact, improved forward guidance for continued strong earnings. And a lot of that has finally began to outweigh some of the macro headwinds that have previously been in investor outlooks. So looking at something like the European Central Bank, the ECB, they cut rates for the eighth time. It's widening the gap with the Fed. That was as recently as early June. That was a headline from June 7th. We'll expand on this a little bit later as well, but it's just an example of diverging global monetary policy. Rates matter. If it's a rate that someone is paying or receiving overseas relative to what we have in the United States, it has impacts on our monetary policy. It has impacts on the dollar and what those currency exchanges might be. It has an impact on the capital flow of whose money is going where for certain types of investments. And so it's headlines that we've been keeping an eye on and saying, what impacts does this have for us ultimately as investors, particularly our fixed income portfolio? What kind of impact can we see there as there's continued changes in the dollar or continued changes in exchange rates? And then just pulling off something else, something like major geopolitical events. June 10th, Israel launches attacks on Iran's nuclear facilities, followed shortly thereafter by the United States as well, indicative of an elevated geopolitical risk. Died down very quickly, but it was one of the most serious geopolitical developments of the quarter. It had the potential to provide a lot of fear into the market, a lot of uncertainty. But for the most part, the market reaction was pretty muted. Despite the severity of the event, markets remained resilient. Investors felt reinforced that focusing on fundamentals was more important than the headlines. If you just continued to invest, even when the headlines were about new potential war in the Middle East, you were rewarded as an investor by just focusing on your strategy, focusing on the fundamentals of the underlying market. This chart is one of my favorite long-term perspectives on stock market behavior because it underscores two important realities for investors. Volatility is common, and markets are remarkably resilient. Each gray bar that we see here represents the total return for the S&P 500 in a given year. The red dots that we see show the maximum intra-year drawdown. So from any relative peak to trough in any of those calendar years. And so in other words, it's just, hey, at any point in time, how far did the market fall at some point during the year? Even if it ultimately recovered and we ended up with a positive return for the January 1st, December 31st calendar year. A few key takeaways here. Intra-year declines are not unusual. In fact, the average intra-year drop going back to 1980 is around 14%. The market finished positive in 32 of those 45 years. So we fully can expect that at any point during a calendar year, not that markets care about what day it is, what date it is, or what calendar year we're in, any year we can expect to see something that feels like a substantial drawdown, 14%. Looking at 2020 as a recent example, the market dropped 34% during the COVID shock and still ended the year up 16%. That 34% was over the course of about 3 weeks. So that wasn't even like a long, drawn out slog of a downturn. It was very extreme. It was very rapid. And when all was said and done, markets recovered, focused on fundamentals, and we still ended up positive for the year. We did look at this chart for the first time in a while last quarter as well as an example of saying, hey, at that point in time, markets were down about 9%. They had fallen as far as 19% at one point in time. But now the story is completely different. Just one quarter later, so far this year in 2025, we've seen as far as 19% drawdowns, and the market is currently up 9% year to date. The volatility is not gone, but investors who stay disciplined have historically been rewarded. Some of the worst drawdowns that we've seen, like 2008, 2002, so great financial crisis, dot-com bubble burst. Some of those worst drawdowns were associated with major economic shocks, but those were eventually followed by very strong recovery. So our key message here is that short-term pain doesn't necessarily derail long-term gains. This is why we focus on staying invested through the cycle rather than trying to time the cycle. Taking that volatility, those drawdowns, and kind of tying it back into consumer confidence. And this is all based off of the University of Michigan Consumer Sentiment Index. How that ties in, how it relates to markets. Hey, how are investors feeling and how is the market doing? What sort of correlation can we draw between the two? And so what it does is it highlights one of the more counterintuitive patterns in behavioral investing. That key insight is that historically, the best forward stock market returns have come after consumer sentiment hits a low, not a high. What we're looking at here is the gray chart is rises and falls in the consumer sentiment index. Any of our blue dots are relative peaks, are relative troughs, which you can only ever identify in hindsight. At all of these troughs where consumer sentiment feels like it's at its worst, there's no way of knowing that soon things are going to get better, sentiment's going to improve, and maybe markets will as well. So this is something that can only be identified in hindsight. But you notice that all of those bottoms, when people felt the worst, is when we see the best returns going forward. An average of 24% returns after those 9 sentimental troughs. That's over the next 12 months of S&P 500 earnings, relative to the 10 sentiment peaks that still have pretty good returns, 4% almost, over the next 12 months for the S&P 500. But it's just indicative that, on average, when we are seeing relative highs, relative lows in consumer sentiment, markets tend to reward those that continue to hold even when things feel like they're the worst. As of July 2025, Sentiment still does remain very low, on a score of 61.8, which is well below the long-term average of 84.1. It puts it near past trough levels of 2008, 2020, 2022, which is a little crazy. I think right now you can also see that the sentiment has been a little volatile. A lot of it is related to, policy. It's related to geopolitical events. But to be able to measure, the concern of consumers, which is, hey, negative sentiment is indicative of, on average, there's some concern. For today to be at similar levels as it was, in the midst of the great financial crisis in 2022, which was our 1 year on, the last 100 plus years where stocks and bonds were both down together about 20%. And then something like the onset of the pandemic, to feel like sentiment is at an equal place now compared to where it was during those times is a little bit striking. But overall, the behavioral takeaway is when consumer mood is gloomy, it just usually reflects a recent pain. It's something like inflation, job insecurity, geopolitical stress. It is not a reflection necessarily of future market performance. In fact, pessimism often coincides with market bottoms. So, because bad news is already priced in, all those headlines that are also negative, all already priced in, expectations tend to be a little bit low. So, the peaks in sentiment often precede weak returns, and the troughs often precede, some of the best expected returns in markets. So, this is a lagging indicator. You can only get this information when you're looking backward at the relative highs and lows. But we need to be mindful of, let's not let emotions, let's not behavior get in the way of our investment strategy, even when things feel bad. Uh, on average, you tend to be rewarded by sticking through and maintaining your investments. So that brings us to one of our first, common client questions. What are the most common mistakes investors make during volatile markets? And how does Aspen help me help them as investors avoid them? So there's, a few things that we see, and they kind of work on two opposite ends of the spectrum. Far and away, the most damaging mistakes that investors or retirees can make during volatile markets include abandoning the strategy that you had in place, moving to cash, fire selling the portfolio, moving out of your investment strategy at the wrong time, which is usually at one of those market bottoms or, sentiment troughs, as we were just looking at. Trying to time markets, getting out ahead of perceived future losses. The move to cash is, we don't get too many serious concerns about it. We have a lot more clients that kind of joke, oh, we're going to move. Oh, I don't know what's going to happen. But that is the one thing that if those conversations ever turn serious, we do everything we can to avoid that, because we know just how damaging it can be. More often than not, when you see the worst days in the market, the best subsequent days are within 2 to 3 trading days of them. So it's very, very unlikely, once you start seeing some significantly bad days, 2+% drawdowns, if you pull out of the market, chances are you're missing some of the best days as well. And quantifying that, for example, if you miss 10 trading days over a 20-year period, if you miss the 10 best trading days, it would literally cut your returns in half over a 20-year period. Granted, what's the likelihood of missing 10 days and only missing the best ones? But it just goes to show the impact that even a few days out of the market, when you're missing positive returns, can have over long-term time frames, where short-term decisions like that can absolutely erode your long-term returns. So far and away, the biggest mistake that we see is anyone who considers going to cash short during volatile markets. On the flip side, another, kind of on the risk-seeking side, is every now and then people feel like in the middle of a bear market that, now they need to be stock pickers, and they say, oh, look at everything's fire sale, everything is on sale. I'm going to pick some really great names. It's as easy now as ever. Look at these great companies that are super cheap. And they abandon the index strategy, the broad market strategy, and they all of a sudden decide that they're a stock picker, as if picking stocks in a down market is any easier than an up market. Probably number two is the other mistake that we see that, hey, all of us, yeah, I've been an index investor my whole life, but now all of a sudden markets are down and I'm going to try and pick a handful of opportunities that are going to outperform from here. And all of a sudden they become a stock picker. It's the opposite end of the spectrum, but we don't really want that as well. Jumping into active stock picking tends to also miss future runs up in outperformance that we get when we are recovering from a market drawdown. Because oftentimes, if the recovery is isolated to just a few stocks, the chances of you having picked just those few stocks is unlikely. So we'd rather invest in the entire market and broadly participate in market recoveries as they occur. Transitioning over to some of our economic updates, GDP growth was negative. So we did see a contraction in GDP growth in the first quarter. Just this morning, there was positive news for the second quarter with some of those first estimates of a pretty wild swing. What was a 0.5% contraction in the first quarter under the first proposed estimates of Q2 growth was a 3% gain. And that was as recently as this morning. But what this chart shows us is the breakdown of that GDP growth, in this case, contraction, by component, and quarter by quarter since early 2021, about 5 years or so. Focusing on the second quarter of 2025, with overall and aggregate real GDP contracting by 0.5%. It was the first quarterly decline since, shift downwards in our GDP since the first quarter of 2024. It had been rising since then for the most part. The first negative print since the first quarter of 2022 when the economy contracted at 1% rate. But the headline weakness, where that overall contraction was coming from, is almost entirely by a sharp drawdown in private inventories, which subtracted 2.6 percentage points from growth, which is pretty substantial. It's a meaningful swing, but it's not necessarily a sign of broad economic deterioration. Inventory fluctuations like that they're often temporary. They can reverse themselves in subsequent quarters. That's not one of the stickier components of GDP that is indicative of a long-term trend when you see one move in it. It's something that can fluctuate pretty wildly. Can't dismiss the fact that very much had offsetting strengths despite the overall contraction. There were positive contributions from net exports of 0.6%, consumer spending, positive contribution of 0.3%, and then business investment as well was a positive contribution of 1.4%. The fact that final sales to domestic purchasers rose 2%, that does suggest that underlying demand remains solid, even if that headline GDP dipped. And then from a historical perspective, consumption has averaged 1.7% as far as its contribution to GDP. It continues to do so, even though it has been a slightly slower pace in Q2. The chart reminds us that a negative GDP print doesn't always mean recession, especially when the weakness is isolated to inventories rather than demand side components. So our key takeaways here: the contraction very much grabbed headlines. It seems like those headlines already shifted in the opposite directions with the Q2 numbers that were being reported this morning. But households are still spending, businesses are still investing, and they are expanding those investments. And what we'll get to next is inflation has cooled enough overall relative to the previous highs. That the Federal Reserve are still considering rate cuts. Big question going forward is just whether the consumer resilience holds up and if they can continue on that path overall. So looking at our inflation components. So far, impact of tariffs on inflation appears to be minor. It does tend to have a lag effect. I do think it'll be a number of quarters before we truly know what impact tariffs will have on headline inflation. But overall headline CPA is coming in at 2.7% year over year in June. That's up slightly from May's 2.4%. Fortunately for all of us, that is still well below the 9.1% peak in mid 2022. And it's also under the long-term average of 3.7%, the 50-year average of 3.7%. So, however, the we do believe overall that there could be inflationary effects from the tariffs, and that they haven't been canceled, they've merely been delayed as retailers begin to mark up new inventory costs, especially on their imported goods. Consumer prices are likely to move higher in the second half of the year. We're already seeing some gradual pressure in core goods, and categories like auto insurance, which are particularly sensitive to replacement parts, labor inputs, supply chain friction. So all of that could be exacerbated with the new tariff regime. I know particularly there have been carve outs for cars manufactured in the United States. A lot of questions around what does it mean to be manufactured in the United States, because a lot of times any one given car is somewhat manufactured in 4 or 5 different countries. But if they're assembled in the United States, there have been proposed carve outs for that. But a lot of those costs could be exacerbated by the new tariff regime. Shelter inflation. Shelter inflation has cooled from its peak, but it continues to contribute meaningfully to headline CPI. Any rebound in housing demand, which could possibly be driven by future rate cuts, could stall or reverse recent disinflation progress. Um, let's see, our last component that we're looking at. So it's very possible, with expert estimates, that headline inflation here could rise to as high as 3.5% year over year by the fourth quarter. What the projections are is that we should see another peak from there, allow the tariffs to work their way through the system, who is paying for what as it pertains to tariffs, and how much are being eaten by American consumers, how much are being paid by producers overseas as that works itself through the system. Um, by early next year, if we were to see a rise in inflation, to see it start falling again to 3%, the Fed overall does believe that we will still hit their 2% target. From what they've indicated right now, it's kind of the back half of 2026. So we may be looking at a ride along the way, lots of factors that could change this along the way. But with the Fed's forecasts of how they see these policy changes impacting costs, they think we're going to move a little bit backwards in terms of inflation, to eventually settle back in to where they target, where their preferred target for inflation is 2% in the back half of next year. So big picture here, headline inflation has improved. At least we're not talking about 9% inflation like we were back in June of 2022. Underlying pressures remain though, so especially in services. If tariffs continue to cascade through the supply chain, it could complicate things when we're looking at that disinflation path ahead. But overall, we're way better than we were 3 years ago, with just a little bit to go until we get to the Fed's preferred target. And it'll be an interesting ride to get to the rest of the way down in terms of inflation. So next step after inflation is talking about the dollar. We mentioned the dollar in our original kind of headlines discussion, because interest rates, inflation, the dollar, consumer demand, and trade imbalances, all of these are very intertwined. So the US dollar has fallen sharply year to date. It's down about 9%, marking a notable reversal from its peak in late 2022. Several forces are contributing to this decline. Some are cyclical, some are structural. The short-term drivers are in part, possibly just a valuation correction. Given that the dollar entered 2025 at historically elevated levels, it was nearly 56% above its early 2008 trough. It may just be a reflection of shifting investor sentiment as well. Not only just a repricing back to normal levels, but a shift in investor sentiment, both within the US and international investors, reassessing their exposure to US assets, using US dollars, amid concerns about our current fiscal, trade, immigration policies and everything like that. At the same time, one of the key historical supports for the dollar, higher U.S. interest rates relative to other developed markets. As we mentioned, the European Central Bank is cutting rates. The Fed has cut rates about 1% since their highest, but has largely paused and plans to continue to do so. And those higher U.S. interest rates relative to other developed markets remaining intact for now tend to be a positive for the dollar. As of late July 2025, the interest rate differential between U.S. and international 10-year bonds sits at 1.6%, favoring the dollar. So with the ECB actively cutting rates while the Fed is holding steady, the spread there may limit further downside in the near term, at least for the dollar. There's also long-term pressures, though. Structurally, the dollar faces persistent headwinds from the U.S. trade deficit, which did reach a minus 6% of GDP in the first quarter of 25, the most recent data that we have, which was among the worst levels in 2 decades. So over time, what we'd expect, a combination of potential for slower U.S. growth, elevated fiscal deficits, and then the potential for rebalancing of global capital flows, given things like those different interest rate dynamics. All of those could continue to push the dollar lower. Historically, the dollar cycles tend to overshoot in both directions, working themselves way above average, way below averages for periods of time. As seen on the left side of our screen here, previous dollar peaks, like those in 85, 2002, 2022, were followed by multi-year downtrends. So the potential impact for tariffs. So again, we seem to be ironing out more trade deals than ever before, but a lot of the impact of tariffs are still just potential impacts. We will talk about this more in the next 2 slides as well. But from an investment implication standpoint, weak dollar can benefit international equities. A lot of the international equity outperformance we've seen is not directly dollar related. They just have their own valuation tailwinds internationally. This could be an additional factor to finally see some international outperformance for the near term. But not only just international equities, developed and emerging, but U.S. multinationals, U.S. companies that do a lot of business globally, and while they may be domiciled in the United States, not necessarily have their entire customer or client base in the United States. All of those could benefit. And then there's the potential inflation implications. So a weaker dollar raises import costs, and it could add pressure to CPI if the decline persists. So in short, while the strong interest rate differential may slow further dollar weakening in the short run, the long-term fundamentals continue to suggest that we could see a gradual depreciation in the dollar, particularly if U.S. growth slows, if trade imbalances remain unresolved, could absolutely see a persistence in the fall of the dollar. All right, so back to tariffs. This chart puts today's tariff environment into perspective. This was as up to date as we could get it as of Monday. But as of Monday, the effective U.S. tariff rate could rise to about 15.6%, assuming no change in imports. So, and earlier this year, it briefly approached a peak of 30%, which were levels that we hadn't seen since the 1930s. That orange line is very much an outlier in the rest of this chart for what the average tariff rate on U.S. goods imports are. So, tariffs, we mentioned the impact on the dollar. How do tariffs affect the dollar? In theory, tariffs should support the dollar, reducing imports, which should narrow the trade deficit, should support the dollar via improved net exports. They can also fuel inflation, which might cause the Fed to keep rates elevated, which would be another short-term dollar support. In reality, tariffs can backfire, as we've seen on the right-hand side of the dollar drivers slide. U.S. trade deficit is still running minus 6% of GDP. So it's suggesting that tariffs have not materially improve to the balance of trade. Retaliation from trading partners is a possibility. Like I said, a lot of those trade deals are being worked out. So the risk of retaliation is getting reduced, at least for the companies that we've already struck a deal with. There's the potential for higher input costs and then reduced export competitiveness. It may actually worsen net exports in the long run. So while higher rates can support the dollar, they also raise concerns about slower growth, debt sustainability, policy credibility, and all of this can lead to foreign capital outflows. There's the potential for confidence risk. Structural dollar headwinds, like a sudden spike in tariffs to 1930s era levels, combined with policy uncertainty, can very much shake global confidence in the U.S. as a trade partner. And we've seen that a lot in the headlines in terms of foreign governments, foreign companies, and their comfort level with buying U.S. treasuries as their proxy for getting into the dollar market. Are they comfortable with owning U.S. treasuries? If international investors begin reallocating away from U.S. assets, it could weaken capital inflows, which is a key source of dollar support in a world where the U.S. runs both a trade and a fiscal deficit. So our summary takeaway before we get into some of the shortfalls of just economic theory in general, as we kind of talked here above, but our summary takeaway on tariffs, um, they might offer temporary dollar support via inflation or interest rate expectations, the broader effect, but especially at this magnitude, it is likely negative for the dollar over time. That reinforces our view that the dollar is overvalued and investors should prepare for multi-year depreciation rather than a sustained rally, and the importance of investing outside the United States in your portfolio with those developed internationals, those emerging market international positions as part of your portfolio. Now, economic theory versus reality is very much a challenge. So, an argument could be made where are tariffs a case where economic theory lacks real world validation? Because a lot of the largest economic theories that we talk about, the sample size in real world is just too small to say exactly what's going to happen. All the academics and all the economists say, oh, hey, my models and my data sets say that this is exactly what's going to happen if we impose tariffs on it. But a lot of times there's just not enough of a real world sample size to validate most of those models. They call it a theory for a reason. And so right now that is partially the case with something like tariffs. We have a few recent timeframes where the theory holds up, which is that tariffs raise prices, they reduce trade volumes, they can create deadweight losses. Um, those would be Smoot-Hawley Tariff Act of 1930, U.S.-China 2018-2019 tariff wars as examples where we were able to see tariffs being applied, what impact did it have on the economy. In 1930, when tariffs were applied during the Great Depression, it considerably worsened it. We are a much different economy now than we were in 1930. But, during the Great Depression, tariffs ignited global retaliation. It slashed trade flows. It was largely, in real world, bad thing for the U.S. economy. Um, the US-China 2018-2019 tariff wars, they saw notable increases in prices, some minor supply chain disruptions, but overall, the most recent example of tariffs, didn't really have material improvements or detractions in the U.S. trade balance overall. So where real world complexity challenges theory is that these small sample size, variables that need to be assumed and estimated, they make it very, very hard to isolate tariff impacts cleanly, especially in today's very complex, very globally integrated economy. So, for instance, while tariffs may reduce imports from one country, it often just shifts trade to a third country, right? So if we were previously importing something from China, tariffs make that prohibitive, and now Vietnam is on the table, and the tariff impact is significantly reduced there. That shifts some of the imports. It doesn't necessarily reduce the imports overall. Domestic substitution depends on how quickly we can replace the production that is one of the major factors right now of if we want to bring manufacturing back to the United States, how fast can we actually do that? Managing manufacturing microchips, manufacturing pharmaceuticals. What is the actual lead time for getting these facilities created in order to do it so that we can incentivize U.S. investment? If we are incentivizing U.S. investment, but we don't have the capacity to actually do that for another 2 or 3 years, where does that leave us for the next 2 to 3 years before we can get our own supply up and running? So where the theory falls short overall is just, what is the long-term impact or the long-term fix for these trade imbalances? It is a complete unknown, regardless of what the theories say will happen and what our deficit will or won't be with long-term tariffs, what manufacturing employment may look like with or without tariffs. Not something that we are concerned with today, just because it is such an unknown factor. We will continue to see development in our economy. We will always innovate our way around problems as it pertains to supply chain issues. And so overall, we need to be mindful of whenever we're reading a headline of tariffs will do this to the US economy, tariffs won't do this to US expenses. We really need to separate the theory from the reality and know that regardless of somebody's headline saying that A very much will cause B, there is a lot of room for interpretation between them. We just need to be mindful. We need to monitor. We need to keep a globally diversified portfolio without trying to guess where the economics are going and in what direction and what magnitude, because reality is not always the same as theory. So tying the dollar and tariffs and trade imbalances back to our continued belief of global equities being a part of an investment portfolio and not even an overweight in an investment portfolio. So many Americans are so comfortable with not investing in anywhere outside the U.S. at all. We're just proponents of having it in a portfolio, which sometimes is a contrarian opinion. But all of that to bring us back to global non-US equity valuations. The first half of 2025 has seen international equities outperform US stocks by a pretty wide margin. Both local currency returns and the tailwind from a weaker dollar driving those gains. Naturally, some investors are now asking, did I miss the opportunity to increase international exposure? We've seen it done so well because it's done so well recently. Does that mean that it can't possibly continue to provide high expected returns or positive expected returns in the future? And for us, we really don't think so. Kind of the three main reasons we believe that they will remain attractive. And again, this is not to try and estimate. I think international is going to outperform the United States, and therefore I will invest in international and I won't invest in the United States. This is always just as an argument as including it in your portfolio overall. The United States makes up almost 70% of the global stock market. The rest of the world is about 30. I think that maybe has come down to about 68, 32. But there is still a lot of markets and a lot of market capitalization outside the United States. We believe it just belongs in our portfolio. But three main reasons that we believe that it needs to be there is that the valuations overall still favor international markets. So even after the strong year-to-date performance, where we've seen quite a bit of price appreciation, non-US equities are trading at a steep discount relative to US stocks. And that is when we compare, the earnings of those companies relative to the price that they're trading at. Shown on the left-hand side, the US trades at about 22 and a half times forward earnings, while Europe, emerging markets, China, they're at 12 times, 14 and a half times, which is a 30 to 45% discount relative to the United States. On a sector relative basis, which is on our right side of the chart, international stocks trade at a 35% discount on average versus the S&P 500, compared to a 20-year average discount of just 18%. So when you look at the 20-year average of where that discount should fall between the two of them, even right now, it is at a considerably depressed valuation relative to this long-term historical averages. In short, despite recent gains, international equities do remain deeply undervalued. particularly when compared to their US counterparts. And especially when you're looking at sectors like industrials, healthcare, technology, looking at our kind of second main point that is a positive for internationals, the currency tailwinds that are likely to persist. We spent a lot of time talking about the dollar decline, what is going to happen with the dollar and rates and inflation and those trade imbalances, very much exists as a tailwind for international markets, particularly if we see more of that capital reallocation abroad. What used to be foreign governments, foreign companies buying treasuries, investing in the United States, holding US dollars, there may be some reallocation there. And then thirdly, many United States investors are still underweight international or not exposed to it at all, as we just mentioned. So, after more than a decade of US market dominance, particularly US tech stocks, most portfolios have become significantly overweight domestic equities. This is a good rebalancing opportunity, making sure that we are improving the global diversification of a portfolio and rebalancing towards international equities could improve our valuation exposure. It could reduce concentration risk and better position portfolios for shifting global leadership. So overall, the final takeaways on international stocks have rebounded strongly, but we view that as kind of playing catch up. It's not done. It's playing catch up. This isn't the end. We're still midway through the process here. The valuations are still compelling. The dollar remains a headwind for U.S. assets. The logical place to look is outside the U.S. globally. And so most investors have room to increase their global exposure, which is prudent in a long-term asset allocation framework. Further tying that in, back to our Fed, back to interest rates. After cutting rates by a full percentage point in the second half of last year, Federal Reserve has held rates steady at the 4.25 to 4.5% range throughout the first half of 2025. This decision has been more debated lately than seemingly ever before, particularly with pressure to convince the Fed to start lowering rates even further. We do expect overall the Fed to stay on hold in the near term, perhaps a single 25 basis point cut by year end. As the data shows us today, the two main reasons for that estimate, which is largely provided by the Fed themselves, when they tend to say that they have a belief and they tell us what they're going to do, I tend to believe them. But overall, the policy uncertainty, first point is policy uncertainty remains very high. So the tariffs, immigration, fiscal spending, all of these things that are uncertain, very well could have inflationary expectations like we discussed. There's a lot of consensus estimates that we see a slight increase in inflation going forward before ultimately getting to that 2% terminal inflation rate that the Fed wants to see possibly as late next year. So until those economic effects are clearer, the Fed is likely to remain a little stubborn, but stubbornly cautious, and particularly in an election year where policy direction may shift sharply in 26. So we're looking at what their plans are for 2026. Secondly, inflation employment trade-off still favors caution. We do spend a lot of time talking about the Fed and their view on rates because of their mandate to manage inflation. Very easy to forget that the Fed does have a dual mandate of managing not only inflation, but in managing employment levels in the United States as well, managing that unemployment rate. So according to the Fed's own June 2025 summary of economic projections, they think that they're going to finish the year with their measured inflation PCE at 3.3%, and it is with employment on the flip side of things being only slightly above what they want to have, and they're expecting a 4.2% estimate for unemployment. In other words, the inflation is way more off target than their employment targets are. They're going to be focused on managing inflation, monitoring inflation, determining how it's going to impact their rate choices is a much, much larger factor than employment levels overall. Next logical step after talking about the Fed, talking about interest rates, are fixed income market dynamics overall. We touched on this very, very briefly with our second slide that had our historic 1 year, 5 year, 10 year plus market performance. In that, when we're looking at 5 year average returns, US stocks in particular are still negative on an annualized basis over the last 5 years. Global fixed income was slightly positive, but not by much, over the last 5 years because of all of those rate increases that we saw in 2022 into 2023. But the bright side of that is where it leaves us today in our fixed income market dynamics. What yields are we getting on what sort of assets? And then on the right-hand side of our screen here is what would we expect in terms of total fixed income returns with different interest rate scenarios, whether there's no change in interest rates, a 1% fall, or a 1% rise. So this slide, it helps frame the current opportunity set in fixed income, especially after the last few years of interest rate volatility. Most important takeaway here is that expected returns across most segments of the bond market are positive. When we see the right side of our screen and our bar charts on the right side of that line, it means that whether rates hold, rates rise, or rates fall, we would expect positive returns, even in a scenario where rates rise by 1%. We learned very much the hard way, or were reminded the hard way in 22 and 23, that when rates rise, bond prices fall. Even in a scenario where rates were to continue to rise by 1%, many of the subsets of our fixed income universe would continue to provide positive return. The reason being is that a 1% increase in rates today is not the same as a 1% increase in rates in 2022 when rates were zero, because we are more protected now by the already higher rates that we have, and prices are impacted less given the same change in rates when the baseline rate that you're starting with is already higher. And that is why in a lot of these asset classes, even if we were to see a 1% rise in rates, we are looking at flat total returns or positive total returns. Doesn't even, above and beyond that, it is not as if a 1% rise in rates and a 1% fall in rates are equally likely at this point in time. Pretty safe to say that rates rising by 1% here are way, way less likely than rates holding constant or rates falling, given that inflation may tick up a little bit, but not to the degree that it had previously, where the Fed needs to completely reverse course and not only not talk about cutting or their decision for how long to hold, but that they need to reverse course back to raising rates again. All of that feels very unlikely. Even if we were to find ourselves there, most subsets of the fixed income market would still look attractive with positive returns. So with the bond market looking more constructive and forward returns less sensitive to those modest rate changes, sets the stage for our next topic with our next common client question, which is, how a diversified portfolio that includes a thoughtfully allocated fixed income target can support retirement income, risk management goals. We get this a lot, which is, I am retired. I'm a retired investor. I'm taking money out of my portfolio. When markets are volatile, how do you decide where to pull retirement income from, considering that my portfolio consists of equities, bonds, or cash reserves? So when we construct portfolios, we do so with the goal of avoiding becoming a forced seller in a down stock market. To do that, we rely first on the income that's generated from our stock position, like our dividends, the income that's generated from our cash and our bonds, like the interest, as the baseline for the distributions off of our portfolio, just the income that is being generated by all the assets that we hold. We do believe in a blended growth and income investment target. We want to have both. But first and foremost, the income being generated off of our portfolio is our first source of funds when providing distributions, particularly in a down market. So from there, we view the cash and the bond allocations that we have like a ladder. The cash position or money market, which is cash plus, or CDs, if somebody has CDs, we view them like the first rung on this hypothetical ladder, where if we need to draw off of our portfolio above and beyond the income that's being generated, cash, money markets, CDs, short-term bonds are the first source of funds that we go to when selling. What that allows us to do is leave our stocks exactly where they are, even if where they are is down. And we are using stable assets with a high likelihood of price stability to know what we're going to get for it to be the first source of funds for our distributions. After that, the next step on our ladder would be the midterm high quality bonds that we have. Um, it, the midterm bonds have a potential to be more volatile than our short-term bonds. When midterm bonds tend to be most volatile is in rising rate environments, which likely is not happening with the exception of 2022 for the first time in 150 years, likely not happening at the same time as the stock market drawdown. Historically, we've had a lot of price stability, if not price appreciation, in our midterm bonds during a market drawdown. That is our next source of funds. On to the intermediate term bonds and beyond as needed to fill out our ladder, looking year over year over year, where are we getting our distributions off of our portfolio? So all that to say, in a 60-40-ish portfolio, those 40% bonds can support on their own through a systematic liquidation strategy, if needed, can support roughly 10 years of distributions. That 40% of our portfolio, we're distributing 4% a year. Very, very easy math would say that we've got about 10 years worth of distributions if we need them right there. And then when you factor in a 2% income yield off of your portfolio, you're looking at that fixed income allocation, if needed, giving you 10 to 15 to 20 years worth of distributions in the absolute worst case scenario. The reason that we really like the math on this is we are not going to need 20 years to get positive returns from US stocks. A lot of times, if given the choice, I like a 80-20 stock to bond portfolio because a 20% fixed income or bond allocation is about 5 years worth of 4% distributions. Historically, US stocks have had positive returns in any rolling 5-year period 88% of the time. If we want to be conservative, we want to know that we have those secure assets, the cash, the money market, all of the spectrum of the bond market. Over a 10-year period, rolling 10-year periods, US stocks have provided positive returns 95% of the time. Does just so happen that one of the periods where they didn't, the lost decade, which was during the dot-com bubble burst leading into the great financial crisis, wasn't that long ago. So it's very much close enough that it is ingrained in people's memories. But from a portfolio construction standpoint and determining when markets are volatile, where we're going to pull our income from, those are all of the reasons that we own the assets that we do in a portfolio. We avoid being a forced seller in a down stock market. We utilize the income, what it's meant for. We take those liquid sources that do not provide us a great long-term expected return, and we use them when they're needed the most, which is in times of stock market volatility. So tying that all back to our implications for investors. In an environment that's been marked by policy uncertainty, global realignment, market crosscurrents, it's tempting for investors to overreact to headlines or short-term volatility. Successful long-term investing is not about timing markets. It's about time in markets with a steady focus on fundamentals, diversification, and disciplined rebalancing. So, here's how to translate our current macroeconomic themes into a sound portfolio strategy. We want to make sure that we stay globally diversified amid shifting tailwinds. It matters because international equities have outperformed US markets in the first half of 2025. And looking at a long-term lens, global diversification isn't a tactical bet, it's a structural advantage. Different regions lead at different times, and a well-diversified portfolio is built to benefit from that rotation without having to predict it. So our actions there are to reassess our international exposure and ensure that our allocation matches long-term targets rather than just recent performance. Don't chase past winners, rebalance with a purpose. Our second implication and takeaway, we are going to position for policy surprise, but we won't try to predict it. And why that matters is that the second half of 2025 could see meaningful shifts in policy, whether that's fiscal stimulus, deregulation, trade renegotiations, especially the trade has been well underway the last week or two, all with uncertain timing and impact. The market is sensitive to the direction of change, not just the outcome. So our long-term lens there is to avoid overconcentration in sectors that are policy dependent. And instead, we want to emphasize portfolio flexibility and resilience across policy scenarios, the actions that we can take. We're going to use core holdings with broad exposure, for example, like a total market or factor-based ETFs. And we're going to reserve our tilts or satellites for expressing views on policy-sensitive sectors, where something like infrastructure, industrials, healthcare, where we can stay balanced, we can own the entire market, and we can still tilt that portfolio to areas that we believe in without being an all or nothing allocation or a true pick and choose. And then lastly, we're going to watch the data flow, not just the headlines. And why it matters is that those key economic indicators like labor market strength, inflation trends, wage growth, productivity, all of those are shaping the Federal Reserve's next steps, and by extension, interest rates, corporate earnings, and discount rates. So the long-term lens with that short-term data is it should inform our rebalancing and allocation shifts, but not drive emotional decisions. So investors who adapt thoughtfully to evolving fundamentals, not the daily news, they position themselves best for compounding. The action that we take there is from an inflation perspective, watching our CPI, PCE prints and understand if the price pressures are cooling or if they're reaccelerating, looking at the labor market and our unemployment rate, job openings, and see if that offers clues to wage growth and consumer health. And then lastly, we're going to listen to those Fed signals. Short-term interest rate moves are not going to be the priority for managing something like our fixed income allocation. It's going to be more on the trajectory and the real yields over time, focused on the long term. So we use this data as a periodic check-in, not as a trigger to revisit the assumptions in your financial plan. And I'm 3 minutes over time, but I appreciate you joining us here today. As always, your circumstances, your financial plan, your portfolio are very, very unique relative to these global assumptions that we make, all of the general statements. So we are here to help. Please reach out to us if there's anything we can do, any questions we can answer. This is our office number. This is our general email. We are here to help with financial plan updates, with portfolio reviews for you or anyone you care about. We are here to help.
Awesome. Thank you, Nathan. And again, if you have any questions or comments, you have our individual emails, and you work with Aspen. If not, you can find them on our website. You can use this number. Going forward for future webinars, we will, I touched on this, but some people joined after the fact. It'll ask you to put your name, email, just general information, but we'll also have a Q&A section that we can add so that we can screen some questions in advance. But thank you for those that added those. And thanks again, Nathan. I know you put a lot of work into this.
Yeah, thanks for attending.